You know, when oil prices spike, most of us really feel the pinch everywhere, not just at the gas pump, but at the grocery store too. But for a certain set of players in the global economy, high prices aren't a problem at all. They're actually the goal. It's this dynamic that shifts literally trillions of dollars around the world. So let's follow the money and find out who really wins when the rest of us are paying more for energy.
Take a look at this number, $91. That was the recent price for a single barrel of Brent crude oil. Now, that might just seem like a number, but it's a figure that reverberates across the entire globe, and it directly influences what you and I pay for fuel. Every single tick up or down on that price represents a massive transfer of wealth. And in this explainer, we're going to follow that money right to its final destination.
So that really is the central question, isn't it? While those rising oil prices mean pain for our budgets, and even for entire countries, they represent a huge windfall for others. It's basically a zero-sum game, where every extra dollar you spend is a dollar of revenue for someone else. Let's break down exactly who's on the receiving end of that transfer. All right, here's our game plan. We'll kick things off with the basic economics connecting oil prices to profit. Then we'll meet the producers, both the huge giants and the smaller, more nimble players. After that, we'll look at the picks and shovels companies that make it all happen. We'll also cover how you can get broad exposure with ETFs. And finally, we'll talk about the massive risks and the wild volatility that's just part of the deal in this sector. First up, oil prices, pain, and profit. Right here, we're going to nail down the fundamental and, surprisingly simple link between the price of oil and how profitable these energy companies really are. So here's the most important thing to get. For a company that's pulling oil out of the ground, the cost to get one barrel out is relatively fixed. I mean, think about it. That giant offshore rig is already built. The land leases were signed for decades. The geologists are on salary. So whether the market price for that barrel is $60 or $90, their day-to-day costs don't really change all that much. And that means every single dollar the market price goes up goes almost directly to their bottom line as pure profit. Okay, so now let's meet the most direct beneficiaries of this whole equation, the producers. These are the companies right at the source, the ones that actually own the oil and are physically pumping it out of the earth. In industry speak, this is called upstream energy. When you think of oil companies, these are probably the ones that pop into your head. They're at the very start of the supply chain, exploring for new reserves and operating the wells. Because of that, their fortunes are the most directly and dramatically tied to the price of crude oil. Now, it's really important to know that not all producers are created equal. On one hand, you've got the large caps, the titans like Exxon or BP. They are global powerhouses with massive, diversified operations and balance sheets that can pretty much withstand any crisis. But because they're so huge, they often have lower growth potential. On the other hand, you have the small cap producers. These guys might just be focused on a single oil field. They're way more agile and can grow like crazy when prices are high, but they also carry immense risk. A single bad well or a sudden price drop could be totally catastrophic for them. This quote, it just perfectly captures the mindset and the reality of being one of these huge, large-cap producers. Their sheer size and financial depth act as a massive cushion against disaster, in a way that a smaller company just could never afford. And here's the perfect, real-world example of that. The Deepwater Horizon spill was one of the worst environmental disasters in history, costing tens of billions of dollars. BP's stock got absolutely obliterated, falling from $60 all the way down to $30. So how did they survive? Well, they sold off some other assets, took on debt, and just leaned on their massive cash flow from other operations around the world. A smaller company facing even a fraction of that crisis would have been gone for good. But for BP, it was a survivable, even if it was a devastating event. Okay, moving on. Beyond the companies that actually own the oil, there's this entire ecosystem of businesses that thrive when drilling is booming. These are the enablers, the picks and shovels of the industry. We're talking about the oil services sector. The best way to think about it is like a gold rush. The people who made the most consistent money weren't always the miners who struck it rich, but the ones selling them the picks, the shovels, and the blue jeans. In today's oil industry, these are companies like Schlumberger or Halliburton. They don't own the oil, but they provide the essential drilling rigs, the seismic imaging tech, the crews, and all the skilled labor that producers need to get that oil out of the ground. Now, their fate is tied to a very specific set of numbers, especially when it comes to newer, more expensive methods like fracking. There's this critical threshold at play. When oil is above $60 a barrel, fracking is super profitable. This means producers are confident they're drilling new wells, and the oil services companies are incredibly busy. But as the price falls towards $50,
margins get squeezed. And below 50? Well, for many operations, that's a deal breaker, and the phones just stop ringing for the service companies as drilling grinds to a halt. And this quote just explains why perfectly. Fracking is this complex, high-tech process. It's nothing like conventional drilling in a place like Saudi Arabia, where you can basically just stick a straw in the ground and the oil comes gushing out. The geology there makes the extraction cost incredibly low. So for these picks and shovels companies, a high oil price is absolutely essential because it's the only thing that justifies the high cost of their very sophisticated services. So you've got the producers and you've got the service companies, and each one has its own risks and rewards. But what if you think the whole sector is about to do well, but you don't want to bet the farm on a single company? Well, that's where our next topic comes in: exchange-traded funds, or ETFs. An ETF is basically a basket of stocks that you can buy and sell in one go, just like an individual stock. So, for example, the ETF with the ticker symbol XLE gives you really broad exposure to the entire energy sector: producers, refiners, all of it. Or if you're a big believer in that picks and shovels idea we just talked about, you could look at an ETF like XES, which focuses specifically on those equipment and services companies. It's a way to invest in a theme without having to be an expert on individual companies. And this is pretty much what that basket looks like. A broad fund like XLE is diversified within the sector. It holds shares in the giant producers like Exxon and Chevron, but also in oil services companies. And it includes midstream companies, those are the pipelines and storage facilities, kind of like the industry's circulatory system, and refining companies that turn crude oil into gasoline. It's really a way to invest in the overall trend of rising energy prices. But here's a really crucial distinction to make. Someone might think, oh, I'll diversify by buying stock in Exxon, Shell, and Chevron. But that's not really diversification, that's correlation. Think of it this way. That's like betting on 3 different horses in the exact same race. If it starts to rain on the track, all 3 of them are going to slow down. All those stocks are giant oil producers, and they're all going to rise and fall based on the same primary factor, the price of oil. And that brings us to our final section. Because for all this talk of profits, the energy sector is notoriously treacherous. It's an industry defined by volatility, by these gut-wrenching boom and bust cycles, and the constant risk of sudden, unpredictable shocks. It's so critical to remember that oil is a commodity, just like wheat or copper. And commodity businesses are famous for their cycles. We've seen it time and time again. High prices encourage more production, which eventually leads to way too much supply, which then causes prices to crash. Then, low prices cause bankruptcies and shut down production, which leads to not enough supply, which causes prices to spike all over again. It's a constant and often brutal roller coaster. And then there's the risk of a black swan, a totally unpredictable event with massive, game-changing consequences. This quote just puts it perfectly. If your entire investment portfolio is packed with energy stocks, you are incredibly vulnerable to a single innovation that could make oil dramatically less important or maybe even obsolete. A fantastic, if maybe a little futuristic example of this would be a small, portable fusion reactor. Just imagine a device the size of a shipping container that could power a small city with clean, limitless energy. I know it sounds like science fiction today, but that kind of paradigm-shifting technology is exactly what a black swan event looks like. It could render the entire multi-trillion-dollar oil and gas industry, all the wells, the pipelines, the tankers, pretty much worthless, almost overnight. So this is the cycle in a nutshell. It often starts with low prices, which choke off investment and bankrupt the weaker companies. Then, some kind of geopolitical shock, like a war or a major supply disruption, causes a sudden price spike. That spike triggers a boom, a gold rush of money pouring into new drilling. But that boom eventually leads to oversupply, flooding the market with too much oil and causing the price to crash, starting the whole painful cycle all over again. And this brings us to the final and most crucial question. With the global push towards decarbonization and the constant threat of technological disruption on the horizon, is the current era of high oil prices the final profitable boom for a legacy industry? Or is it simply another turn of the wheel in the long, volatile, and fascinating cycle of energy? That is the multi-trillion-dollar question we'll all be watching unfold.